Hello and welcome to this episode of MC Explains, an investor education initiative brought to you by Moneycontrol and Invesco Mutual Fund. Today we will discuss how to manage your short-term surpluses efficiently. Do you know that money lying in your savings bank account earns interest at a low rate? With inflation at around 4% to 6% a year, it means your surplus money is losing value every day that you leave it unattended in your savings bank account. Is there a way to make your money work harder? This is money that you may need in a week or a month or 2 months and just need a place to park it till then. What we call short-term parking of funds. There are certain types of mutual fund schemes which you can use very effectively for this purpose. Within the debt fund umbrella, asset managers have a subcategory of funds which cater to this very requirement. Look for overnight funds, liquid funds and money market funds to help you with this short-term parking of money. Let me explain how they work so that you know the benefits and can decide what suits you best. First, let's discuss overnight funds. The portfolio of an overnight fund invests in debt and money market securities which mature in one business day. The objective is to generate low-risk returns with high level of liquidity through investments in very short maturity securities. The portfolio mostly consists of cash equivalent where money is parked overnight predominantly in tri-party repo or TREPs. This is a bit technical but basically parked overnight. As a category, the average maturity of the schemes is practically at 1 day and annual expense ratio charged is low, ranging from around 0.1 to 0.2% a year. These funds do not have an exit load, which means you can withdraw your money as you need without any penalty. The returns in the fund will be quite close to the overnight call market rates in India. So overnight funds do what the name suggests, give you an avenue to park very short-term surpluses and the flexibility to withdraw when you like, as much as you like. This fund can also be used to build an emergency fund to meet unforeseen contingencies in your life. Now coming to liquid funds. Liquid funds are slightly different from overnight funds as the portfolio restriction extends to investing in debt and money market securities which have up to 91-day maturity. Typically, the average maturity for funds in this category is around 1 to 1.5 months. The increased average maturity means that the portfolio has slightly higher interest rate risk than an overnight fund and hence you can also expect a slightly higher return. Liquid funds also invest in overnight securities and they invest in short maturity treasury bills, but also with that they invest in commercial paper, certificate of deposits, government securities and corporate bonds. You are looking at an annual expense of around 0.15 to 0.35% in this category. Liquid funds are ideal for parking money that you may need in say 2 to 3 months. You should be aware that there could be a nominal exit load if the money is withdrawn before 7 days of holding. Lastly, there are money market funds. If you are looking for parking your money for anywhere between say 3 to 12 months. Money market funds function similar to liquid funds except that these funds can invest only in money market securities with a maturity up to 1 year, which means that the interest rate risk notches up slightly compared to liquid funds. It is ideal for money that you don't need for say 6 odd months. The expense ratio is also higher at around 0.25 to 0.75% a year and the returns are usually higher than a liquid fund. As you may have noticed, leaving your surplus funds in one of these types of debt funds provides you with an opportunity to earn market-linked returns, which is not the case with money lying idle. There are few other things you need to keep in mind for all 3 types of funds collectively before you decide to invest. Firstly, don't forget to check the riskometer and the PRC matrix for the fund. Ideally, you're looking at a fund which has lowest risk as per the riskometer and one that falls in the A1 box of the PRC matrix. This means that you are taking the lowest possible risk while parking your money. Secondly, you can invest small amounts of say 500 rupees or 1000 rupees in these funds, and you can withdraw anytime you want. Typically, the money will be credited to your bank account after 1 day. Thirdly, any gains from these investments are subject to tax at the rate of your income tax. Lastly, you can also benefit from compounding of returns if you eventually don't need the money and it remains invested for a longer period of time. So there you have it. Using these debt mutual funds to park your short-term money is an efficient, flexible, transparent way for you to make your short-term surpluses work hard.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.